welcome to the Business Standard Morning Show. I'm Nadia Iqbal, and here's a look at the stories for the day. This holiday truncated week ushered in Samvat 2079. Investors across the country are hoping that the new year will bring good tidings with it and will take the market to a new height. But fingers are also crossed due to ongoing global uncertainty. Meanwhile, the focus for the week ahead will remain on the ongoing earnings season, global cues, and FII flows. Our first story today will help you prepare better for the trading week ahead and will also tell how analysts see the markets shaping up this year. The markets entered Samvat 2079 on a strong note with the BSE Sensex and the Nifty 50 rising 0.88% each in Muhurat trades on Monday evening. While the Sensex surged 525 points to end at 59,832 levels, the Nifty moved up 155 points to close at 17,731 levels. In the process, the frontline indices logged their best Muhurat day gain in 14 years. The last time the markets witnessed this stupendous performance was in the Muhurat session in 2008 when the Sensex and the Nifty surged 5.86% and 6.35% respectively. And in the last 5 years, the markets have always given a positive return on Muhurat trading day. Meanwhile, the mid and small cap indices on the NSE moved up around 0.5% and 1% each in Muhurat trade on Monday. Among individual stocks, leading the gains among the Sensex stocks in the Muhurat session were Nestle India and ICICI Bank. Both the stocks rallied over 2% each. State Bank of India, HDFC Twins, Dr. Reddy's was some of the other key gainers, rising between 1.25% and 1.7% in Muhurat trade. HUL, on the other hand, ended 3.05% lower at 2,574 rupees levels on the BSE. However, technically the market seems to be on a strong footing. Here are the key levels to watch.
Global markets are presently going through a turmoil phase, tracking cues from geopolitical tension, Fed thinking of another interest rate hike, and Treasury yield soaring day by day. Global economists are deeply concerned about US economies as well. However, here in domestic market, BSE and Sensex both are placed really well. While making a comparison between Dow and Sensex and Nifty, one could definitely see the rebounds and the pullback that Indian markets have shown post-June 2022. US markets have thereafter went to hit new 52 weeks lows, breaching 30,000, the sentimental mark. At this moment, benchmark indices, BSE, Sensex and Nifty are facing moderate and minor hurdles. For Sensex, 59,000 becomes the immediate hurdle, whereas for Nifty, 17,500 is the next resistance mark. Once these hurdles are crossed, definitely Indian markets are going to see fresh all-time highs. On the downside, Nifty has a support of 16,800, whereas for Sensex, the support comes at 56,000 levels. When try to evaluate between Nifty small cap and mid cap, Nifty mid cap is definitely holding ground about 29,500 and it can rally to 32,000 levels. Whereas Nifty small cap, which is currently showing a sideways momentum, has a support of 9,100 and it can see a resistance of 10,000 levels.
On the earnings front, speaking on the current market trend, Ajit Mishra, Vice President of Research at Religare Broking, expects the markets to rally if there are no disturbances and broader markets to play catch up in the near term.
Markets have recently witnessed a breakout from the consolidation zone after spending nearly 2 weeks into consolidation, and we are seeing a gradual recovery since then. But if you see that the major contribution to this recovery is the global clues, especially the recovery in the US market is basically fueling this momentum. And we expect this, move to continue, provided there's nothing, major happens in the global markets. Means the global market will sustain the move that we are currently seeing. At the same time, if we talk about the index, 17,100 is what we are eyeing in Nifty as a critical support in the near future. And gradually, once we see this recovery unfolding, a level close to around 18,100, which is the previous swing high, might act as a resistance. In between, the broader indices, they are witnessing a mixed trend, means that they have not participated in line with the index so far. But going ahead, we expect a catch-up move. But considering that we are into the earnings season and the other factor also comes into play, one should be remain selective in this space and stick with the fundamentally strong counters, because we might see restricted participation to continue in the broader markets at least in the near future.
Going ahead in this holiday shorted trading week, global cues, FII flows, rupee movement, monthly FNO expiry, and the ongoing earnings season can sway the market mood either way. Chennai Petro, Dabur, PC Jeweler, SBI Cards, Tata Chemicals, Blue Dart, Dr. Reddy's, Maruti Suzuki India, Tata Power, and Indian Oil are some of the prominent companies scheduled to announce earnings this week. Movement of a cricket ball can also be as tricky and nerve-wracking as that of any stock. About 10,000 kilometers away from the financial capital Mumbai, the air is thick with excitement. 7 stadiums of Australia are hosting the ICC T20 World Cup, and in one of them, at the iconic Melbourne Cricket Ground, India defeated Pakistan by 4 wickets on Sunday evening, giving fans of the Rohit Sharma-led side a perfect Diwali gift. But what else makes this event different? And will it prove to be better than the previous ones? Our next story has the answer.
The India-Pakistan encounter in the 2021 ICC Men's T20 World Cup became the most viewed T20 international match in history by clocking a record reach of 167 million viewers. When the T20 World Cup returned after 5 years in 2021, it also broke viewership records in several regions. So, are we going to witness another record-breaking year? Namibia pulled off a shock win over 2014 champion Sri Lanka on the opening day of the latest edition of ICC T20 World Cup in Australia that began on 16th October and set to run till November 13th. On the second day, two-time winners West Indies crashed to another shocking 42-run defeat by Scotland. These are indications of more interesting things to come. The 8th edition of the Global Showpiece Tournament features 16 teams playing 45 matches in 7 Australian cities spread across 4 different time zones. The marquee event will expand to 20 teams in 2024. With the completion of the qualifying phase, where 8 teams battled for 4 vacant spots, the Super 12 started with a bang in Sydney on Sunday when the hosts met New Zealand in a rematch of last year's final. India were dealt a huge blow with Jasprit Bumrah ruled out due to a back injury. Mohammad Shami, who has not featured in T20 International since the last T20 World Cup, was drafted as his replacement in the squad. India, Australia, England, Pakistan, New Zealand and South Africa, in that order, are the top favourites this year to lift the trophy. Pakistan have one of the strongest bowling attacks in the world.
So I think this tournament is literally better placed as compared to last year's tournament. So it's quite an open tournament. I don't see the emerging teams, being winners. But definitely, these underdogs or emerging teams can play a spoil sport if they were to win at least one match with any of the larger teams which are there. I definitely believe that there is some kind of fatigue which is setting in because there is too much cricket on a back-to-back basis. But I think these are marquee tournaments which are always viewed in large groups by a large set of audience, and I don't see any kind of a negative impact in terms of viewership share. All I expect that because of the time zone being very different this time around, that the matches will be in the afternoon or in the evenings. You might see digital actually doing better as compared to TV, because a lot of content in terms of the matches which are at 5 p.m., 4 p.m. kind of time frames, a lot of catch up will happen on the digital platforms. Apart from that, if you look at the TV plus digital, if you look at the overall eyeballs or the numbers in terms of where they are trending, the growth rates over there, I don't see a significant challenge on that front, unless India underperforms drastically.
The reigning champions, Australia, will look to make most of the home conditions to defend their crown. Australia are also hosting the T20 World Cup for the first time. No host nation has ever won the T20 World Cup, and no team has won back-to-back titles in the 15-year history of the World Cup. But at the same time, Australia are the first to defend the title at home. A number of changes to playing conditions by ICC have come into effect on October 1st. In a format of small margins, these changes may become match-defining and deciding moments in Australia. The law related to the running out of a non-striker while they back up out of the crease, informally called mankading after former India cricketer Vinu Mankad, has been moved from the unfair play section to the run-out section. With the normalization of the practice, especially after Deepti Sharma's run-out of Charlie Dean during India's tour of England last month, non-strikers will be on their toes. A change that came in earlier this year is the in-match over rate penalty. The failure of a fielding team to bowl their overs by the scheduled cessation time leads to an additional fielder having to be brought inside the fielding circle for the remaining overs of the innings. The use of saliva to polish the ball has also been permanently banned. Further, when a batsman is out caught, the new one will come in at the striker's end, regardless of whether the batsman crossed prior to the catch being taken. A new penalty is also in place for when the fielding side breaches the law on unfair movement. Any movement deemed unfair and deliberate by fielders while a bowler is running into ball now results in the umpire awarding 5 penalty runs to the batting side, in addition to the delivery being a dead ball. This time around, India, the world's top-ranked T20 side, will be looking for a much better showing than their group stage elimination in 2021.
India matches generally fetch a very high premium as compared to the average of the tournament which is there. Now, if you compare this from a last year to this year in terms of growth, I think last year we were at somewhere close to about 800 to 1,000 crores, for the T20 World Cup. And the pricing was around 9 to 10 lakh for a 10-second slot. And generally, if you look at the marquee tournaments on a CAGR basis, they've been growing at close to 15 to 17% in terms of the ad realization which is there. But this time around, I think there will be a challenge for growth because of two reasons. One is, of course, the internet companies, the new age startup companies are not spending that aggressively as they were compared to last year. Broadly, 20% of your ad spends today are coming from these new age e-commerce kind of companies, and that could have a significant impact on the ad spends. In terms of monetization, close to 70 to 75% of your ad revenue comes from the TV medium. Now, because this tournament is going to be, showcased in Indian Standard Time in the afternoon and the early evening kind of time frame, you might see a negative impact in terms of viewership of TV. And that will eventually have a negative impact in terms of overall ad revenues as well for TV, which will have an impact on the overall ad revenue of the tournament as a whole.
Elara analyst Karan Taurani says the viewership gap for the tournament between digital and TV is just about 10%. But because of favorable time zones and mobility restrictions going away, digital viewership could end up crossing TVs this time. This T20 World Cup will attract an estimated TV audience of 390 to 400 million and digital audience of 350 to 400 million. However, TV will still command a higher ad revenue share, but viewership growth will be substantially better for digital. The Australian event follows a run of 4 T20 World Cups in Asia. As such, fast bowlers will enjoy Australia's bouncy wickets. With more teams better placed than last year, a new host country and interesting rule changes, the fight for the $1.6 million trophy will be anything but a boring affair.
Back home, Diwali marked the beginning of Vikram Samvat 2079. How will this year be? How will global slowdown affect India? And when will steps taken by the RBI to rein in inflation start showing results? Business Standard's individual Dasmana caught up with Rakesh Mohan, the president of the Center for Social and Economic Progress and also a part-time member of the Economic Advisory Council of the Prime Minister and a former RBI Deputy Governor. Here's how Mohan answered these questions and more.
Here with us is Dr. Rakesh Mohan, who is currently president of the Center for Social and Economic Progress and member part-time Economic Advisory Council to the Prime Minister. In the past, he had served many important posts such as RBI Deputy Governor, Chief Economic Advisor, Economic Affairs Secretary. Welcome, Dr. Rakesh Mohan,
Thank you.
to our show. Many analysts, including Nouriel Rubini, has cautioned against long and ugly recession, global recession, which may start by the end of this year and last till the end of 2014. How do you see the impact of that recession on India, given the fact that exports growth have already started decelerating in September?
This current period is characterized by a kind of uncertainty that the world has not seen for a very long time, including the North Atlantic financial crisis of 2008-9, which was the last big sort of financial crisis affecting the whole world, because a number of things have happened at the same time. First, of course, the COVID epidemic, both the impact of the actual epidemic, plus the impact of the lockdowns, etc., in most countries. Second, of course, the impact of the Russia-Ukraine war. We still don't know in each of these cases, that is the COVID as well as the Russia-Ukraine war, what is ahead of us. Yes, we are, I think, hopefully almost seeing the end of COVID, but we don't know. As we know, China continues repeated large lockdowns in large cities, which has affected Chinese growth. And that, of course, given that China is now the second largest economy in the world, that affects the whole world. So that's the first two, COVID, Russia, Ukraine. Third, that since over the last 14 years, we have had a continuous regime of very, very low interest rates. And of course, low inflation. Now, that seems to be changing. Again, we don't know how this is going to end or what's going to happen in the future, because we haven't the Western Europe, the United States, and so on having inflation rates of between 7 and 10% is something no one has seen for the last 40 years at least, if not longer. And I would also say that people don't quite fully understand what's causing such high inflation rates, apart from, of course, the energy issues raised by the Ukraine war and so on. But the issue that has arisen is that since the 2008-9 crisis, there's been a general understanding of central banks going down to do monetary accommodation for a very, very long time. And because inflation did not rise until last year or so, or last couple of years, that we thought we'd come to the end of inflation and of the effectiveness of central bank actions. So combining all these things, it's very clear that there's huge uncertainty for the future, including uncertainty about how we should tackle the current situation in the world. Now, what that means is that that given all these disruptions, that there's no question that global demand will slow for all the three reasons. That is monetary tightening as a response to inflation, the Ukraine-Russia war disruptions, the COVID disruptions, etc. And fourth, I would say, is that something I think has not been talked about enough, is the demographic change that is going on. This is a medium-term issue, not, of course, an immediate issue, of population growth going down everywhere, including ourselves. Certainly China, Japan populations have been decreasing quite some time. So there's going to be an impact on global growth for the medium term. So in that context, we can't expect to be untouched. And therefore, given that we are among the better performing economies in the world, and we hope that we will continue to do so, but we have to be aware that we are significant, we are part of the global economy, and so there can be no decoupling. And so we have to be very conscious of this issue and everything going on in the world and tailor our actions accordingly.
You have talked about inflation, and it has remained elevated since January, despite Monetary Policy Committee hiking repo rates since May. Does it mean that while Monetary Policy Committee is taking resort to policy rate hikes, the problem lies somewhere else on supply side, and the whole thing is misplaced?
As you may know, that I have never been a votary of the inflation targeting framework. Right from the time that I was in the Reserve Bank and later while teaching monetary policy and central banking, etc. at Yale. But leave it aside for a second. What we do know is that monetary policy impact has a pretty long lag. So the actions that you take now, you really expect to see the impact something between 3 to 6 quarters from now, or 4 to 6 quarters from now. So if we started tightening in May, to expect something to happen immediately is basically mistaken. But I think one of the negative impacts of inflation targeting frameworks has led people to have excessive confidence and belief in the effectiveness of monetary policy on affecting inflation. Of course, it does affect inflation. I'm not disputing that. But the view that, look, inflation has gone up, you tighten, so suddenly it'll come down. That won't happen. It takes time for monetary policy transmission to take place. One thing that we need to be conscious of even now is that we can't really say that monetary policy is tight. That naturally, with the repo rate at 5.9% in India, with 7.4% inflation rate in September, and the wholesale price index, of course, has come down. It's been coming down somewhat. It's still 10 plus. So the policy rate itself is still negative in terms of the real interest rate. So with no stretch of the imagination, can it be called an accommodative policy rate? To say that that the monetary policy has been tightening or is tight is basically incorrect. And I think that there is need for monetary policy interest rates to come to some degree of normality relative to expected inflation. Now, if you say that, look, my expected inflation now is 4%, say over the next 2 years, then one would conclude that, look, around 6% policy rate is pretty normal. So it really depends on what kind of inflation expectations that you think exist, because one of the roles of inflation targeting is actually to anchor inflation expectations. So if we do believe that inflation expectations are indeed anchored at the RBI's target of 4%, then yes, a policy rate of around 6% is sort of approaching normality. So I think there are many different factors that need to go into thinking about monetary policy in the current circumstances.
Thanks a lot, Mr. Rakesh Mohan, for talking to Business Standard.
The prices of essential commodities would have been much more had it not been for the good monsoon. It is withdrawing now. The low pressure area in the Bay of Bengal may lead to cyclonic storms. Excess rains wreak havoc at times, triggering floods and landslides. Such calamities need government intervention, which in turn taps into the disaster relief funds. Let's find out more about it.
Most of us grew up seeing the visuals of flooding in Assam and landslides in hill states of Uttarakhand and Himachal Pradesh. Rescue operations have almost become an annual affair in these parts of the country, and so is the rehabilitation. Keeping these occurrences in mind, and also the unforeseen events like earthquakes, the government had formed a disaster management framework. It seeks to build a safe and disaster-resilient India. National and state disaster response bodies deploy corpus funds for this. The State Disaster Response Fund is the primary fund available with the state governments to deal with notified disasters like cyclone, drought, earthquake, landslide, flood, tsunami, etc. The centre contributes 75% of the allocation in SDRF and 90% for the special category states in 2 equal installments according to the recommendation of the Finance Commission. According to the Ministry of Home Affairs, funds from SDRF must be used only for meeting the expenditure for providing immediate relief to the victims of such disasters. For local disasters specific to states other than the notified ones, the state government can use up to 10% of SDRF funds. The 15th Finance Commission has recommended an allocation of Rs 1.6 lakh crore to the State Disaster Risk Management Fund, which also includes the SDRF from FY 2022 to FY 26. The Commission noted that of the total funds allocated to SDRF, 40% could be used for response and relief works, 30% for recovery and reconstruction, and 10% for preparedness and capacity building. Meanwhile, the National Disaster Response Fund, NDRF, supplements the state funds in case of disasters of severe nature by providing additional funds to the state governments. For availing the NDRF funds, states are required to submit a memorandum indicating the sector-wise damage and need of funds. The centre, on its part, assesses the damage and grants additional funds to states. The disaster relief funds have also been a bone of contention in the recent past between the centre and states. The centre says that the primary responsibility for disaster management rests with the state governments, and it supplements the efforts of state by providing requisite logistics and financial support. Some opposition states argue that not enough funds are being released from the national corpus. Apart from the NDRF and SDRF, some special funds are also created to deal with disasters of large scale and magnitude. For instance, the Prime Minister's National Relief Fund was established entirely with public contributions and does not get any budgetary support. In the pandemic year, the government has come up with PM Cares to strengthen the fight against COVID.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
8 Indian states have now adopted an international framework for assessing losses and damages in the aftermath of a disaster. They are Assam, Gujarat, Karnataka, Himachal Pradesh, Jharkhand, Odisha, Maharashtra, and Meghalaya. Well, that's all we have for you today. We will be back with more news and analysis in our next episode. Stay tuned. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.